Hi, everyone. This is Jason Bierek of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today, instead of doing a normal interview, our audience is going to be treated to more of a discussion-type format where Modawu, John Manfreda, and myself are just basically going to talk about how we see the markets are changing, the general stock market. We're going to try to talk about the oil market, and then we're going to try to talk about some of the other cross-currents that are going on in the currency wars, especially with Japan. So, guys, let's just weigh in right now on what we see going on in the general stock market.
All right. Well, I'm actually looking at a Dow Jones chart, and it looks like it just keeps making a cup. It's going upwards, and it just keeps making a cup, and it looks like it's gone sideways, and it looks a little overbought, and it looks like I think it's going to form another cup, but the cups get smaller and smaller. And I think this cup is going to be another small one because the Fed's doing everything it can to prevent any type of painful market correction or crash. So, but it does look a little overbought here at 14,000, I think. And I think the sequester, that's not priced into the market yet.
Yeah, I think the market is way overbought. So I'm looking at the chart. If you look at the indicators, and all the indicators is saying that the general stock market is overbought, and I'm expecting a correction here sometime soon. Now, it could happen after March 1st if we get the government cuts. So I don't think it will be a major crash like other people are predicting, a 1987 type crash, but I do see a correction coming here, and I think it will happen after March 1st.
Yeah, I think we could easily have a correction here since we do in terms of flow of funds, we do have a lot of retail money starting to come back into stocks, and those people are normally the quote-unquote dumb money. But also, the funny thing is you do have the retail money, which is the dumb money, come back into stocks, but you also have the smart money going into stocks. And those are those Keynesians, the deflationists, the people who didn't believe in inflation, who have drastically underperformed, guys, the S&P 500. I think the statistic is 9 out of 10 hedge fund managers have underperformed the S&P 500 by a lot in the last year or two. So it's pretty insane right now. These guys, they have career risk. If they don't come in and they don't start performing, they're going to have all those institutions and those large flow of funds, those feeder funds, just pull their cash out because, the returns have been bad in some of these hedge funds for well over a year. So these are the types of things. Plus, you have the central bank intervention here. You have the plunge protection team. So, Mo and John, I really would be surprised if we see a market correction larger than 15%. I don't even think we'll see that much. I mean, we could. But then what's going to stop, QE 4.5 or QE 5, or the Fed announcing then that they're going to expand their balance sheet then from, what's it, $85 billion a month now, right, to $100 billion or $130 billion or whatever. And then, as we know with the currency wars, right, when the Fed expands its balance sheet, you have all the countries that are pegged to the dollar have to expand their balance sheets, and that money is going to go somewhere. So it's money does not sleep. The money is either going to go into the real economy in those other countries, or it's going to become a speculative asset. It's going to become hot money, and it's going to go into the U.S. markets for speculation, or maybe into the real estate market. It's just going to start creating more of these asset bubbles that we're still seeing, which the Fed has basically. I mean, just looking at it objectively, the Fed's basically been able to reflate bubbles, hasn't it, guys?
Yes, they have. I mean, after the housing bubble, they started the debt bubble, and before the housing bubble, they started the dot-com bubble. So they're one thing they're very good at is starting bubbles.
And they've actually gotten better at reflating them, right? Because it looks like the real estate market, our contacts in the real estate industry. I mean, we interviewed Fabian Calvo a week or two ago, and he was telling us that there's not much shadow inventory left. A lot of it's being bought up for cash. And, the question is, where's the cash coming from? And a lot of the cash, right, is from Chinese investors, is from foreign investors, is from hedge funds. And it's not from the people that would normally buy houses, right? The mom and pop people who are actually going to live in the houses.
Yeah, that's absolutely right. In fact, I was just about to say, a lot of foreigners are coming in because they're trying to diversify out of their home country with geopolitical diversity. The only thing is, what I don't get is why are they buying in California? out of all the states, you could find a little bit more friendly climate than California.
Because Europe is even worse. John, as bad as California is compared to the rest of the United States in terms of taxes and stuff like that, property taxes and all those other things,
Yeah.
California on a relative basis, I would say, is better than Europe in terms of like being a property owner. Because if you're a middle class, European, you can buy a pretty decent house in California for a fraction of the cost and retire there than you could buy, a retirement property in like the French Riviera or one of those Club Med areas.
I just think like if you're gonna choose somewhere in the U.S., like go to like Florida where there's no income tax. That is beautiful weather too. Or
I agree.
Texas has no income tax, but you do make a point. That is, they're probably comparing it to Europe, and California they have the reputation.
Well, California's on its way to Europe, though, right? Okay, so basically then you guys see more of the same then continuing then where the Fed's, the Fed and other central, well, mostly the Fed, is going to be managing the markets higher than basically through, if they see a dip in the market, they're just going to come in with more QE and expand their balance sheet. Is that what you guys see?
Yes, I agree. We don't have a free market anymore. If we had a free market, the market would collapse. But we have a managed market now, so I expect them to continue to prop up the market.
Yeah, because I've researched a lot of large cap dividend stocks, as you guys know, in the last few months, just looking for value. And to be honest, a lot of the large cap ones, consumer staple ones, are very overvalued. I've looked at a lot of balance sheets, I've looked at a lot of income statements, and the revenues, guys, have been flat for years. A lot of the earnings are manufactured, in a clever way through accounting gimmickry. What a lot of these management teams are doing is because the cost of capital is so cheap for these large companies, because they have cash flow and they have assets and the Fed has manipulated the interest rates low, right? These guys have been able to come in and borrow billions of dollars, these large companies, and buy back their stock. So they can literally, and then, they raise dividends, they're doing share buybacks. So that's how they manufacture earnings growth without, real revenue growth. A lot of these large multinational corporations on American Exchange, some of them are not even growing their revenues 1% per year. So that's how you can, I guess, raise your earnings per share, 10% or 15% per year, is by you lower your share count, you reduce the denominator. So that's what's been going on, and the stocks have been going up, and people, I guess, right, are so desperate for yield because the bond market's not giving any yield, right? And there's been a lot of people, like I said, underperforming who are in bonds, or a lot of portfolio managers who had too much money in cash, and they've missed this market move. So now they're risking their whole careers if they don't try and play catch-up.
Yep. Peter Lynch said it in his book, though. He said it best. Sometimes the share buyback's better than any type of acquisition growth, because it's guaranteed increased earnings, and that does drive up a stock price. And that's the thing about human nature. Anytime they see earnings, the herd's going to jump in, they'll bid up the stock price, and it's easy to bid it because they can borrow for nothing and then get a good return off a bid up stock price and then repay their debt back easily. So
yeah, and those earnings,
if you're on Wall Street right now.
Yeah, and those earnings are manufactured, guys, because if you're not raising your revenues, right? If you're not raising your revenues and your earnings are higher, what does that say about your profit margins then? Your profit margins are probably going to be suffering too, but for the fact that you can borrow really cheap. And, a lot of the CEOs and the guys on the board of directors and the upper management at these large corporations, they're not entrepreneurs. A lot of them don't own a lot of shares. So they're going to try to, a lot of them, unfortunately, guys, they're not long-term value creators. They're rent seekers. So they're going to do anything they can. They're going to try to over-leverage the balance sheet with massive amounts of cheap debt if they can get a little bit more earnings in the short term, right? Because if a lot of their pay packages, right, are based on stock options, if they can move the earnings needle higher each quarter.
And yeah, I'm looking at a chart for one of the consumer staple dividend stocks like Johnson & Johnson, and they recently made all-time high. I'm looking at other dividend stocks as well, and I'm seeing a similar trend here. So yeah, you're right. A lot of these stocks are overvalued.
And some of them, Mo, are selling at 30 times forward earnings with no growth. And that shows to me, guys, how desperate everyone, professional money managers, retail investors, everyone is for yield.
Yeah, definitely. And I'm looking at Johnson & Johnson's operating margins, and in 2012 it was around 15%, and now it's coming down to 14%. Their operating margins have come down 3%. It really shouldn't be going up, but, it's asset. If you have a good consumer staple, they're going to bid up those assets. And in Weimar, Germany, I remember when money died, the stock market was a very high performing in bad inflation. Like, we're more of the stagflation, but I think this will be a little different from the 70s. I think consumer staples and consistent stocks with yield will perform well in this stagflation. It won't be like the 70s where it was just gold, silver, and the energy sector, I think.
Yeah, I think basically, guys, you can chime in on this. I think basically the Fed has successfully managed to financially engineer a nominal bull market.
Yeah, I agree. Since the 2008 crisis, they've done a great job popping up the market by printing cheap dollars and flooding the market with the cheap dollar and having Wall Street manipulate the market using high-frequency trading. So there's a lot of factors going on that making the market disoriented right now.
Yeah, definitely. Oh, one other thing I was going to say. Look at Pfizer. I'm looking at Pfizer right now. I'm just hitting up. This has gone up, in its 52-week range. It's gone up from 2075 to 2784. Now it's at 2729. But their profit margins are even dropping. I see 16% to 9%. And that's their profit margins. Their operating margins are down a little bit, and yet the price is going up. This is a perfect example of just bidding up assets. And Pfizer, they are consistent with their revenue, so the cheap money is inflating these stocks.
Yeah, so we have a real estate bubble that the Fed has been basically reinflating with cheap interest rates, and then all the QE programs and the money's going in there and the hedge funds and all that, and then we have the stock market stuff. So let's I think we've done a good job covering our general views of the stock market here. So we could have a correction. I don't think it's going to be a complete market crash unless we have a black swan where maybe like Europe collapses, an actual country in Europe is allowed to fail, or a large European bank is allowed to fail, which I don't see that happening, guys, because the Fed is now giving over $230 billion with a B dollars a month to European banks in like currency swaps or whatever, just to prop those up too. As we predicted, I think over a year ago, we were talking about this well over a year ago, how the Fed was going to do large currency swaps to Europe and the European banks, so the ECB wouldn't have to print, and just prop up those banks so there wouldn't be any contagion. Let's talk about Japan now, guys, because I think that's the black swan. People talk about Europe, but hardly anyone's been talking about Japan. But what I see now in Japan, and this is the key to me, and we've talked about Japan at other podcasts, but people need to watch the exchange rate to see the games. After Abe was elected, and looking at the exchange rate here, you've seen Japan devalue just in the last 6 months. Their yen against the euro, it's been devalued about 30%. And if you look at their devaluation over the last 12 months against the dollar, it's almost that much too. It's over 20%, or it's around 20%. So isn't that pretty crazy, guys? We have the currency wars. So what's your opinion here on the currency wars in Japan entering them, though?
Well, if you've been listening to what a lot of the experts are saying, a lot of them are saying that Japan will be the first one to fall in this currency war. Mainly because, as you said, they've been printing a lot of money with the new prime minister, and the Federal Reserve, not the Federal Reserve, but the Bank of Japan are aiming for a 2% inflation rate every year in Japan. So you combine that with the money printing, and also a lot of the...
Mo, that 2% is just to negate the yen, so it doesn't strengthen against the dollar and against the dollar, because the U.S. Through financial repression, right, is running a 2% nominal GDP targeting inflation rate, right?
Right. So, even though the real inflation rate is, depends on what you're looking at, is somewhere between 7 to 11%.
Oh, I think it's at least that on a lot of consumer staples. Food, energy, natural gas price. My utility prices are not any lower. education prices, insurance prices, all those basic staples that people need to survive is going up. The consumer discretionary goods, those things are going down. Joseph A. Bank just continues to I don't want to pick on them too much, but there's a lot of companies in similar situations. You had originally in, I think, 2008, Joseph A. Bank was like buy one suit, get one free, and that was to survive. And now I think it's buy one suit, get three free, or get four free. It's just they just keep destroying their margins in desperation to survive, I guess.
Yeah. Well, I just want to say, like, I shop at Joseph A. Bank, and we're not picking on their product or saying they're a bad company. Like, I enjoy their suits. Well, it's just the environment that's killing them. That's what it is.
Yeah, they're a discretionary company, John, because, I mean, once you buy 4 or 5 suits, right, I mean, they're going to last you a while. They're not going to go bad like a smartphone or something. They're not going to become technologically obsolete in a year or something like that. So they're very discretionary item. Once you buy a certain number of suits, you're pretty good for a while, right? So that's the problem that they have, is they can't really generate any growth in this environment. The U.S. consumer's purchasing power is being zapped. U.S. consumers getting squeezed through both ends, through the inflation tax and then higher unemployment and then higher direct taxes.
Yeah, well, not only that, yeah, definitely. And not only that, if you don't have a job, you don't really need a suit. You know, you have no one to visit or anything. So
well, if you don't have a job, John, I mean, and you're gonna go buy a suit, maybe you're gonna try to go to the job interview, but maybe you'll borrow a suit or something like that. Because I remember reading during the Great Depression, 1929, there were people who couldn't afford suits and stuff like that, and they had to borrow like a family member suit to go to a job interview to try to get a job during the 20s and the 30s.
Yeah, that's what they would do. They borrow it. They wouldn't buy it, but if they got the job, they go buy it. So Joseph A. Banks might boom, 10 years from now, but right now, man, it's not. Gosh, not a lot going for him.
Victim of free market forces.
Yeah.
So if you're looking at the chart right now for the yen, if you compare it to like the euro, as you mentioned before this podcast, like against the euro, the yen has gone down like 30%, and then if you look at the yen compared to the dollars, the dollar is up around 20% compared to the yen. So
and the Japanese stock market has responded to the devaluation and already I think it's up over 20%.
Yeah, so the Bank of Japan have done a good job devaluating their currency.
They followed the Keynesian playbook. Well, I wouldn't say it's a good job from a free market perspective, obviously, but I would say it's a good job, like in terms of making their politicians happy and like trying to give their exporters, Sony and Toyota and Honda and those guys, some of the other firms I'm not going to mention, like somewhat of a boost, because those firms are, except for Toyota and Honda, like some of the other firms in Japan, like Sony and Sharp, have really been struggling. I think Sony's debt now is at a junk bond, and its market cap is down more than 90% in the last decade.
Yeah, you're right. That Sony is struggling, and part of it because they're not executing very well, and the competitors are destroying them, like Samsung and Apple.
Yep. Okay, guys. Well, I think that's a good part of Japan here. So I think Japan is the main black swan, because people are already aware of Europe, but I think Japan is the most near-term needs, and that doesn't mean because of that, then the problems in Europe and Japan, the dollar is not going to collapse immediately. So the people who are saying the dollar is going to collapse like any month from now, I think we would see the euro or the yen probably collapse first in the most case. Do you guys agree with that?
I agree with that.
Yeah, I agree with that. And one thing about the Japan companies is the multinationals, like it might cheapen their exports in the short term, but like Toyota, they outsource a lot of their labor to the U.S. because of their aging population. That could really be a big backfire for these multinationals in Japan that really help them, because they outsource a lot of their labor, and so their labor costs will go up, and they won't be able to make cheap products again.
Yeah, I agree, guys. In the short term, the devaluation only helps. Excuse me, I'll rephrase it. The devaluation only helps the exporters in the short term. In the long term, it probably actually hurts them.
Yeah. So Japan, this is really like they're definitely not thinking long term, and I think at one point now, the Japanese yen is pretty short. but their
What?
multinationals might be a great short 2 years from now.
Sorry to interrupt you, John, but what politician does think long term? name me any politician really that thinks long term. So it does not surprise me that the politicians in Japan and the central banks are copying the Keynesian playbook or the neo-Keynesian playbook, and they're short-term rent seekers.
Yeah, I can only think of one, and he's dead. His name's Eisenhower. And he, just what I was referring to is he actually wanted to build a SPR, a Strategic Petroleum Reserve, because he said we'll no longer be able to produce enough oil to consume us. And, of course, Lyndon Johnson stopped it. So I think he's the last one I can do, and that was in the 50s. So.
And a lot of people wonder why a lot of these politicians are short-term thinkers, and a lot of them only care about getting reelected and bring home the bacon so they keep their people happy. They don't care about what happened to the country in the long term. All they want to focus on is getting reelected, keeping their voters happy, and making sure that they pretend that everything's okay in the economy when obviously it's not okay. And they've done a good job doing that, unfortunately. So, that's, as you mentioned, part of the Keynesian playbook that they've been doing for the past, since 1970s when Nixon took the dollar off the gold standard.
Oh, yeah, the Keynesians have been in power, though, Mo, for a lot longer than that in the most cases. The Keynesian economics came to power during the 20s, basically with Herbert Hoover. Herbert Hoover was a hardcore Keynesian.
Yep.
He's a hardcore interventionist and Keynesian. Okay, so let's talk about some other things, then, that could affect the stock market, then. We talked about potential black swans. We talked about Fed intervention and maybe the Fed starting announcing a lot sooner than people think, expanding its balance sheet even further if the market crashes or if there's a quote-unquote deflation risk, like a disinflation period. But let's talk about something else that could also crash the markets, and that's the oil price. So we have the petro business cycle, and you can go to Financial Sense and read Jim Poplava's article. I think he does the best job of explaining the petro business cycle. The oil price, and we talked about this in our oil report. We said basically right when oil was around $78, $80, WTI was around $78, $80 a barrel, oil was going to be a good investment. If you wanted to get long oil futures, if you want to start buying oil service stocks, if you wanted to buy those types of investments. And oil has, man, it's returned very strong. I mean, that's been because of the somewhat of a recovery in China. But talk about, guys, your opinion of the dangers of a higher oil price then on the real economy.
Well, obviously, when you have higher oil prices, it affects a lot of the corporation, especially in a value chain or supply chain, because when oil prices goes up, their input cost goes up, and they'll be forced to raise their retail price or wholesale price of the product and service they provide. So that would hurt the customers because now they have to pay more for the same good and service that they were getting for compared to a year ago. So that's going to hurt their profit margin and it's going to increase their operating expenses. So that's one of the ways that higher oil prices is bad for the economy.
Yeah, it's definitely a lot of different things. And, of course, not only that, trade and commerce. If you cannot it's hard to have a free flow of goods with high oil prices. It won't be able transporting goods around. It's not as easy as it is. It's a lot harder with $90 oil than it is $60 oil. And one of the things, though, also about oil that's the biggest, detriment, too, is when you have artificially, I forget what I was going to say.
Well, John, you can come back to it, bring it up if you, since we're not going to edit this, you could come back to it if you remember what you're going to say. But let's just talk then, we talked about the petro business cycle, but I think oil could stay, I don't see a super spike in oil prices unless we have a conflict in the Middle East. So I think in this sweet spot here, because the oil price is pretty high, let's talk about the oil market, the oil sector, and what types of investments, because in the oil refiners, the last 12 months, some of these oil refiners, because of the fundamentals of how the oil market has shifted, there's infrastructure issues, there's cheap Bakken crude oil for the light oil refiners here in the United States. These guys are minting money now, right, off the WTI and Brent spread and off the crack spread, which is when you take oil and you turn it into all the petroleum products like gasoline and plastics and all those other things. Those profit margins are going through the roof, and the refiners have not had these types of profits in years.
Yeah, it's amazing how different. This is what I was going to say. How different environments can change on the dime, because the refineries were getting hammered, especially with the new ethanol regulations with the blended gasoline. But because of this Brent WTI spread and
the Bakken, the shale oil revolution, right? Because it's selling at such a discount, right, to WTI. Yeah. It's a huge spread for them. They can buy the oil, right? They can buy the Bakken crude oil
and sell the gasoline at Brent.
Yeah, so they can buy the crude oil at $50 or $60 a barrel, and then their products are then priced off Brent. So that's a huge spread.
Yeah, and it's doing really well for them. So I would say the refineries are in good shape for a couple of years. The only thing is right now they're pricing in a huge glut in the U.S., and I personally think this day will come. I don't know when it's going to come, but Canada is going to stop selling us as much oil as they want. They're going to start selling to China. I think they're already in the works right now. And not only that, Saudi Arabia and China, they're trying to build the world's largest refinery. And Saudi Arabia wants to sell for China, because what would you rather do? Sell for China, who won't complain about prices, or the U.S. consumer when oil gets to 90 or 100, they throw fits. So I think eventually that glut's going to turn into a shortage, and the Brent and WTI will even. When that will happen, it might take a couple of years. I don't think it will happen right away.
I think the whole oil patch, all the industries in the oil patch, you have your pipeline companies and your master limited partnerships, which are not exposed to commodity risk and have fee-based businesses like a toll road, where they just toll the oil through the pipeline and they take their cut there, and they're negotiated supply contracts that way. I think those are going to make a lot of money. Those are good long-term buy and holds. They're basically like consumer staple stocks, because people are going to always use a certain amount of oil, because I just don't see it going away anytime soon. I think refiners like Valero, I'll mention a few names here for our listeners, a couple names of the larger companies. I won't mention any smaller ones. I think Valero, I think Marathon Petroleum Corporation, and I think Phillips 66 are all in pretty darn good shape. In terms of refining profits for probably the next 6 to 12 months. These guys are getting really big analyst upgrades from all the Wall Street analysts for earnings upgrades. They're getting big earnings upgrades. They're increasing their dividends, and they're announcing larger than expected stock buybacks. So that tells to me that the management teams of those industries, of those companies, in that industry, think that this trend can at least continue for at least like 6 to 12 months. It might even be longer than that. In terms of the rest of the oil sector, what is your guys' opinion of the oil and service companies, the drillers and those guys? And what's your opinion of the exploration and production companies? Because the exploration and production companies, the oil price has gone up, but not all the oil exploration and production companies have gone up.
Well, we know one of them that's doing very well during this time. We won't mention the name, but I think the exploration company are in a good position here to try to take advantage of the stable condition in the oil market, to try to go ahead and try to take their production to the next level, or try to get whatever oil well they have out there, try to get it quickly in production before we see any type of down movement in the oil price. Because when you compare the oil market to the gold and silver junior miners, one of the main advantages of the junior oil sector is that they are able to get their production online faster, and therefore the cash flow comes in a lot quicker. So the investors that want to invest in the oil market would have to pay attention and really get in at the right time, compared to the gold and silver sector, where it takes a couple years for the stock to go up, and there's a lot of delays on the mine to get into production, and sometimes they hit they missed their guidance for the first year. So I think investors should take a look at the junior oil sector and try to take advantage of it.
And let's put in a plug there, guys, because our report, the Petro Profit Report, which is free for our listeners if you go to our website and give us your email address, covers a lot of companies that are already making money producing oil, small, medium, and large-sized companies that we think are undervalued, that have good growth opportunities, that we think will outperform over the next 2 or 3 years and over the long term. And some of the stocks have gone up. We're not going to mention specific names in the report. You know those if you have the report and you bought some of the stocks. One of the stocks is up over 140%, I think, in the last 18 months or so, and it's got over an 11% dividend yield. But there are a lot of other stocks that we think could be as good as this stock in the next year or two that we have in our report. So definitely go to our website and check that out. And let's wrap up the podcast.
Oh, I was going to say one other thing. With the oil stocks, I think the oil sector is really going to, over the next 18 months, is really going to outperform. One of the reasons is the institutional and hedge fund money has sat on the sidelines for a while. They're starting to nibble at it again, and I think they're going to start going full force pretty soon. I think they see that these prices are the norm. Over the 6 months ago, people were debating where oil's going to crash or not. I think there's more of a consensus. Oil's not going to 40. It's not going to 60. You know, this is probably the steady rate, and it could go higher.
Well, there's a lot of reasons why I think the oil sector will outperform in terms of investments, John, but I think a large part of it is because of China's recovery now, and China is starting to buy more cars again. There was no growth whatsoever, I think, of car increases in China for over a year, right? And now that number is starting to increase again.
And also, I just wanted to mention that a lot of when you're looking at the oil junior sector, the ones that are producing the light sweet oil, I consider the ones I like the most because those type of oil is very rare. And so I think the market will pay a premium for those type of companies that produce the light oil.
Yeah, one other sector I don't like it this year, but is the oil sands. I think once one of those pipelines is approved, the oil sands will start getting bid up. They're going to start being bought out. I think right now they can't get to market. You know, the Northern Gateway pipeline, which will export, oil to China, I think once that's brought up or the Keystone's approved, then the oil sands sectors is going to be able to get to market. They'll be able to sell it. A lot of them will be able to sell at WTI or Brent pricing, and I think they'll do well, but I think it's going to be a rough, next couple of months for them. Because they don't have the pipeline infrastructure yet.
In terms of safe plays for our listeners, like we talked about the Canadian Energy Trust and the Master Limited Partnerships, and there's just a lot of those companies, and some of them are yielding 6% to 9% dividend yields. They have good earnings growth. You have to learn about how those businesses work, though, like the pipelines and stuff like that. But in terms of the other companies, like the large cap oil stocks, I think some of them are fairly valued or getting close to overvalued. But I think the foreign ones, the ones in Europe, Total seems pretty undervalued to me. Eni, the Italian company, seems pretty undervalued. That's a 5 or 6% dividend yield, and the market panicked because it perceived that they have European exposure even though they don't. And then Royal Dutch Shell, I think, is, over 5%, John? I think that's a very solid play for more conservative investors who listen to this podcast. They should definitely take a look at stocks like that. I mean, I'd much rather have exposure to those stocks than, say, any exposure to bonds, any exposure to other riskier investments. Because, I mean, people are still going to pump, even if the economy does get worse, even if stagflation increases as we expect it to, right? People are still going to put gasoline in their cars. I mean, they're only going to be able to cut back so much, right?
Yeah. And I was also going to say, in terms of Royal Dutch Shell, it has a great valuation, 7% PE ratio, only 8% institutionally owned. So once the institutional money piles into it, that will really push up the price. And it has a 5% dividend yield. You can just sit back and wait. And another great thing is, a lot of companies, they can't get Obama to build them a pipeline. TransCanada is the most famous one. Royal Dutch Shell, they're great at kissing up the governments. Like, I know this is sort of bad, but they're great at it. They won't let Obama won't let a lot of companies build pipelines, but he's letting Royal Dutch Shell drill in the Arctic. If you ask me, drilling in the Arctic under all those ice blocks and everything's more dangerous than building a pipeline. Yet Royal Dutch Shell has been able to convince the government to let them drill in the Arctic. Meanwhile, they won't let anyone build a pipeline. So,
and Royal Dutch Shell is also the leader, right, out of all the large oil companies in LNG, right, outside the United States, right?
Yeah, I forgot to add that. And Total, in terms of valuation, they're looking great too. Institutionally owned, 6%. PE ratio is a little higher, but it's like 7%, and it's
7 times earnings. Okay.
Yeah, 6% dividend yield. Like,
and Eni, the Italian company, which no one talks about, has a very similar valuation too.
So, yeah, I like these.
And the drillers, and like a Schlumberger or a Baker Hughes, those guys are good too, right? Because they're fee-based businesses. They're not taking that much commodity risk, right? So those guys are probably going to get more work as more conservative investments too.
Definitely. Now, one final subject we want to get into before we wrap up here, the precious metals market. Now, last Friday, gold and silver got beaten up. Gold was down, I think, about $25, and silver was down about 80 cents. So it presented a major buying opportunity for any precious metals investors. And I know a lot of the bullion dealers were very busy on Friday, right, John?
Yeah, we were. Definitely, especially around 12, when gold went down to that 1600 mark, and silver went in that 20 range. Oh,
that 29 range? It dropped below 30? Yeah.
Yeah, those phones were ringing off the hook.
And that's a discrepancy, guys, right, between the real demand for physical, which is just exploding. You have central banks, which are humongous net buyers now of physical gold. You have humongous investor demand increasing for physical gold out of China. And basically, the paper price just keeps getting knocked down. I mean, this cannot continue for that much longer because eventually the miners who produce the gold, who have to make money, right, in order to keep the gold supply, the gold market functioning, if the paper price goes much lower, the miners have an all-in production cost. A lot of miners, the larger ones, their production costs are rising very, very rapidly. Their grades are declining. In a lot of cases, their average grades now are below 1 gram per ton of gold for every ton of ore rock they mine, which is ridiculous. And, basically that's not a good margin. So, their production costs are already over $1,300 an ounce for a lot of miners all in. On their marginal, and their deposits are more and more marginal every year. Their costs are going up. I would say, especially for miners outside of the United States, a lot of them, their costs are going up more than 10% per year. So these miners are going to say, eventually, right, we're going to postpone our large projects. We're going to cancel or cancel them or write them down. I mean, you're having Barrick, right? Hasn't Barrick written off a couple $1 billion worth of assets on their balance sheet because they're uneconomic at today's gold prices?
And you talk about the gold stock and the silver stocks. They're as cheap as they were back in 2008. So it presents a great buying opportunity for people that want to continue to buy more of their favorite gold and silver stocks. And looking at the chart right now, I think that the gold and silver is oversold, obviously. And
things can be oversold for a long time, though. Right, Mo?
Yeah, it can be. So for people that want to get in, this is a great time to get in.
So what are safe ways? Obviously, professionals should really only be picking juniors at this stage because the juniors have been the ones that have been hit the hardest. These guys don't have earnings. A lot of them, their stocks are down 90%. They're going to have a tough time raising money. Some juniors have only $200,000 in the bank and less than 6 months of working capital. Those are probably not companies people should be buying. So you don't have to talk about specific companies, guys, but talk about the size of companies and what's important in this market, when we're going in a cyclical bear. Because obviously we're still in a secular long-term bull market, but, and this is what a technical trader would say, we're in a cyclical, which is a short-term bear market in these stocks.
Well, Well, with the rising input costs, I think one of the things investors should look at is the grade of the mine they are developing. It has to be economical at this point, since they're dealing with rising input costs for them to mine it. Well, that's one of the things that people should look at. Another thing that I think is very important is the management team. What type of CEOs and CEOs do you have running these type of mine? Do you have CEOs that just have experience, running junior exploration companies, or do you have people that have experience, taking a mine and putting it into production and hitting the target
hitting,
production and stuff, et cetera, et cetera? Those are the type of management that I like. I don't like CEOs that jump around from exploration companies here and there, because that tells me they're not really committed to what they're doing, and if things don't go well, they just bail. So that's another thing I look at. And another thing I look at is the growth in the production. And you want to look at, we like to see higher growth each year coming in the coming years, and you also want to invest in companies that are about to go in production or already in production. So those are the type of companies that I like right now.
Yeah, and I also like the turnaround plays. I like the companies, and we could talk about a specific company for our listeners to do some research on. You have like a Brigus Gold, which is BRD. You have a Kirkland Lake Gold. These companies are in production. Maybe they've had a bad last year or two where they haven't produced at the amount of ounces of gold that they told the market they were going to produce at. So the stock sold off a lot, massively. But if you those are the times, after the resource stocks, and investments in general, guys, you got to be willing, as a contrarian, if you're a value investor, you got to be willing to do good research and take calculated risks. And by all means, do not buy all of your position at once in a resource stock. Never, never, never. But you got to be disciplined to buy low and sell high. So those types of companies, like a Kirkland Lake, which was an $18 stock, it's down to $6. They are earning some money right now. It's not up to the level the market expects. I think that's a pretty good potential turnaround. I think Brigus Gold is in a good stage. And there's a lot of companies. Those are only two off the top of my head. But there's a number of companies like that in that situation. And I think listeners, if they accumulate these shares, if they buy their positions and they keep cash just in case the stocks go a little bit lower, I think they're going to do very, very well in terms of percentages, returns in 2 or 3 years from now, when the gold and silver markets finally do, the correction and consolidation phase ends, and we finally move higher. Because I know, I'll be the first to admit this. Like, I expected gold and silver to break out after QE3 and QE4. I did not think that stuff was priced into the market, and I'm surprised that the market has corrected so much. So, it's a manipulated market. It's a managed market. As is, I guess, all markets, guys, right? When you can manipulate LIBOR, the bond market is manipulated. The currency markets are, as we've demonstrated before with the JCB and the Fed, it's massively manipulated because the Fed's devalued massively against the euro and propped up and made the euro very strong. So, anything else you guys want to add?
Yeah, I just want to say, in terms of, I've watched the price now. When I'm not with Wall Street for Main Street, I'm at my full-time job. I watch the price every day from trading since October, from 8, before hours trading till 5 till I get off work. And I personally think, just from watching every movement, every second, 29 is probably the bottom for silver. There is just too many buyers rushing to the doors. Whether it's Russia, I guarantee you probably Putin. I can't prove this, but Putin was probably backing up the truck yesterday. He is
definitely
buying gold.
China, though.
Yeah, definitely China. I think Putin in terms of percentage, I'm not sure. I know he's been buying a lot. He might be the largest in terms of percentage from his holdings. But China has so much gold. Even it's just tradition there that it doesn't. I don't know if that statistic would mean anything, but and I think gold around 1,600. Those are the bottoms. So I don't see it correcting that much more. Anything can happen. One thing I like to look for also in a silver and gold stock, management ownership. If they own a lot of it, they have your interest at heart. So management ownership is key.
I think the real sweet spot in the market, besides the turnaround plays, the producers that have had production problems where you can buy the reserves for pennies on the dollar, and if management fixes the production problems, you're going to get a big return. I think the other real sweet spots to invest in the sector are the royalty and streaming companies. There's only 4 of them, really, for gold and silver, and then also the mid-tier producers like a First Majestic Silver, would be the best example in the silver category, or a New Gold, which is a larger mid-tier producer. Those would be good, safe mid-tier companies to invest in the gold and silver sectors for most of investors, and pretty conservative, like I said, because they're already making money and they're well managed.
Yeah, I would say if you want a safe, well, I don't think there's anything as a safe junior, but if you want a safer junior than normal, like my favorite junior is Silvercrest, 45% management ownership. They're going to double production in 2014. They're even increasing production this year in 2013, but it's not too much. But 2014, they're going to double production.
And Sandstorm is financing their upgrade, too.
Yeah, so I think Silvercrest is a good, like if you want a spec play, Silvercrest will probably be the safest, but, you know, it's spec. Nothing is 100% safe when it's in the speculation department.
Okay, and we'll put the caveat up, guys, the disclaimer that the stocks we talked about, that's only our opinion. Our listeners need to do more due diligence on their own. They should not go out and buy immediately just because we said that we mentioned a stock on this podcast. Okay, well, let's wrap things up, guys. If you have anything else you want to talk about, any specific analysis of the market or anything you think we missed, and then we'll close things.
I just think that people should pay attention to how the market reacts once the so-called government cut kicks in after March 1st. I could see a small correction. I don't think we'll see a, 2000 or 1987 or 2008 type crash there. So I think investors should be prepared for that.
Yeah, and I just want to say, if you're a gold and silver bug, have a lot of mining stocks. I know it's been a rough couple of 14 months, but don't, get too discouraged.
Do not panic sell.
Yeah, I was going to say.
Do not panic sell unless your company is not making any money, the stock, and they can't sell any more shares. Then I would probably cut my losses then.
But I was just going to say, in terms of gold and silver, the sector, remember why you originally invested in it. With the valuation, poor economic climate, a lot, all the reasons.
Yeah, nothing has
are
changed.
Still there. They're
nothing,
even,
so they're getting worse. Except markets are going up.
Yep. So before you give up on a sector, remember why you got into it, and if those reasons change, then you might want to change it. But with gold and silver, those reasons aren't changing.
Well said, John, and I'll throw in my 2 cents here. I've been putting more of my own money where my mouth is, and I've been adding to gold positions, silver positions, and oil positions in the last month or so.
Ditto. Me too. Disclosure. So.
Yep. So thanks everyone for listening, and we'll try to do more interviews. We've been very busy. We just got back from a really good conference where we saw John Mackey, the CEO of Whole Foods, well, the co-CEO and founder of Whole Foods. He presented on his new book. The book sounds really exciting. It's called Conscious Capitalism, and I think our listeners would really enjoy his book. You should definitely go out and buy it and read it because I think he talks about all the misconceptions about capitalism. And I think it'll be really educational for most people out there.